Okay, so this is a chart of the FTSE, and we're looking at a monthly chart. Now, the first part of the formula to positioning yourself against the amateur trader is firstly identifying the long-term trend in the market. I'm sure you've heard of it, but the trend certainly is your friend in trading. So that's the first piece of the puzzle. You do need to work that out. Now on the FTSE, whilst we are above this level here, it's actually 5550. Let me just put that in. This level here is very, very important. So you'll see that during the Corona crash, we had a spike on the monthly charts. We really dipped below here. This was completely rejected and bought up. So whilst we're above here, the FTSE really does have a really nice solid base, and we can expect further upside. Now, unless I see a daily acceptance bar, which is a full daily candlestick close at body and wick below there, which is actually part of a previous training video that we gave you, I'm bullish on the FTSE, and I'm expecting further upside and eventually up to around 7,000. But of course, you know, that could take many months and even a year. So in the meantime, really we're positioning long on any pullback that we get, because as we said, the charts and the price is telling us that this is heading higher whilst we're above this region here, and we'll continue to do that until the market tells us that we're wrong. So on that basis, we're looking for buys. So then we need to start looking at, well, what are the key areas to look at? So we'll then move to a daily chart. Now on the on these charts, we actually identified that we wanted to buy the FTSE at 5,800 last week. That's really where we were looking to get in. So you can see that this is a really nice area of demand. It's a support zone, and we really want to wait for that level and get in. Now, of course, a lot of the amateur traders or the retail market will already be long, and they'll be using this as a reason to put their stop loss around this level, because it's an obvious support level on the charts. So what we want to do is we really want to wait for the market to come down to this level and stop out the retail market, and then we want to get long. Now, of course, before we get long, we need the market to obviously confirm that actually the market really will be bought up here, or we're going straight down and lower. So we do need a buy signal. So that's the daily chart. We've now identified the key area to buy. And then sometimes we need to be a little bit patient for that level to get hit. But we certainly were waiting for that last week. And then we move on to an hourly chart. So what we saw on Friday, actually no, I think it was Thursday, we were waiting for the market to come down to 5,800. And really what I wanted to do is I wanted to see price action get below 5,800, stop out all the retail market, and then I was looking for a buy signal. Okay, so the buy signal we used is the Bollinger Band. So let me just put onto the charts. I want to put this on. I want to put the Bollinger Bands on here. Now, this is an hourly chart. This area here is an area where the market is in balance. When the market moves away from this, it is imbalanced. So really what we want to do is we want to wait for an hourly bar to get below 5,800, but then we want to see a break back above. Now you'll see that this hourly bar closed actually above 5,800. So had it closed below 5,800, I probably wouldn't have taken this trade. But it did close above 5,800, and really what we did is we just waited for a break of this level. Now we didn't get in, normally we get in a 2-pip break, but actually that was a little bit too obvious. We waited to get in 5 points higher, just in case there was a false break and the market slipped back below. So we got in at 58.10 here. So again, we identify the demand zone where that's the optimal point to buy, the cheapest price. We've already identified the trend is up whilst we're above 5,500. We wait for the market to do a stop hunting mission, which was to take out 5,800. All those people would have had their stops below there, probably around, well, they either would have put it at 5,800 or 57.98. That's the obvious levels. We wait for them to be stopped out, then we wait for an hourly confirmation signal. On the longer charts, we do want to wait for something on the 1 hour. We don't want to be using a 5-minute chart or a 1-minute chart. That's for very, very small trades or scalping trades that occur on a daily basis. But we wait for the hourly bar to close above 5,800, then we wait for a break above the highest point in the bar, and then we're in. And really our stop, well, I wouldn't have put my stop below here. Again, too obvious. The market could have just come down here, clipped everyone out, and then gone back up again. So we were using an acceptance level below this level, that just in case. And then of course we're actually targeting 59.40 for this level. It got close to that level. It got up to 59.35, which is an unfilled gap. But we're actually expecting higher prices next week, and I do believe we'll get up to that 59.40 level. Either way, we've actually made the trade risk-free by taking half profits, which again is a key risk management formula in professional trading. Okay, so hopefully you found that useful. And again, in your trading, focus on obvious areas where the amateur trader is going to get stopped out. Focus on those demand zones. And again, on previous videos, we've talked about stop zones. So again, the markets and the market makers will go for the stops to maximize trade activity in the markets. So we really want to be using different stops. We want to be positioning differently against the herd.